Welcome to the Dinar Daily, your dedicated space for developments surrounding the Iraqi dinar, the Vietnamese dong, and the shifting tides of Zimbabwean currency movements. We begin today's coverage by analyzing one of the most electrifying and widely discussed anomalies to hit the alternative currency community in recent memory. Just as the midday trading session was settling into its usual rhythm, specifically at the stroke of noon Eastern Standard Time, a series of unprecedented digital signals reportedly surged through the internal financial infrastructures of several top-tier United States banking institutions. This was not described as a localized error or a simple server malfunction restricted to a single branch or region, but rather as a widespread, synchronized event. Reports indicate that this phenomenon pierced the standard operational quiet of the banking sector, triggering immediate attention from those who monitor these secure systems. It was a moment that seemed to defy the standard protocols of daily banking, initiating a wave of analysis and debate that has since rippled across the global financial underground. According to numerous accounts surfacing from within the financial sector, employees at major institutions, specifically recognizable industry giants such as Wells Fargo, Bank of America, and Fifth Third Bank, witnessed a startling deviation in their data feeds. These reports suggest that internal foreign currency modules, which are strictly secured and accessible only to authorized banking staff, suddenly populated with what appeared to be drastically revised exchange rates for both the Iraqi dinar and the Vietnamese dong. These were not the typical fractional fluctuations seen during standard trading hours. Witnesses described the numbers as being significantly adjusted, presenting values that align more closely with the long-discussed theoretical revaluations than with the current market rates. Although these new figures were visible on the screens for only a fleeting moment before vanishing or reverting to restricted or out-of-service status, the psychological impact on the observers was immediate and profound, serving as a catalyst for intense scrutiny. The reaction within the digital finance community was instantaneous, resembling a spark hitting highly combustible material. Within minutes of these alleged flashes occurring, the online landscape dedicated to currency speculation saw a massive surge in activity. Telegram channels, which often serve as the rapid response nervous system for this community, flooded with screenshots and first-hand testimonials. Simultaneously, Reddit forums and message boards that have spent years debating the mechanics of global monetary reform swelled with new engagement, as thousands of users sought to verify the data. The atmosphere was a complex mixture of excitement and caution. While some commentators immediately hailed this as the definitive breakthrough everyone had been waiting for, others urged a more measured approach, warning that without official confirmation from global governing bodies, these digital flashes remained unexplained technical anomalies. Despite the lack of immediate statements from the Central Bank of Iraq or the State Bank of Vietnam, the sheer coordination of the event was enough to reignite the fervor of investors worldwide. To understand the significance of this event, one must look at the history of how financial infrastructure updates are typically managed behind the scenes. Veteran observers of the global currency landscape have long noted a specific pattern associated with these rare, synchronized system behaviors. Historically, when the intricate architecture of foreign exchange systems is being prepared for new rate structures or major transitional phases, the internal networks must undergo rigorous rounds of back-end testing. These are not public-facing operations, but are instead complex simulations that include temporary rate injections, system-wide refresh cycles, and network-level stress tests. The goal of such operations is to verify that data can propagate correctly through the labyrinth of multiple institutions without corruption or delay. Under normal circumstances, these tests remain entirely invisible to the public, hidden behind heavy firewalls and secure banking consoles. However, during periods of massive scale upgrades, Visibility leaks can occur, allowing a momentary glimpse of the testing data to flicker across front-end screens. The specific nature of today's anomaly aligns almost perfectly with the theoretical profile of a visibility leak during a major system propagation test. Crucially, the revised rates for the Iraqi dinar and the Vietnamese dong did not appear on consumer-facing websites or the major public forex data platforms used by retail traders. Renowned financial portals such as Bloomberg, Reuters, and XC showed no indication of these new values, maintaining the standard market rates throughout the day. This discrepancy is vital to the analysis because it implies that the activity was strictly confined to the interbank or sovereign-level systems. The deep institutional layers where liquidity is managed and where only authorized banking actors participate. If this had been a simple internet glitch, it likely would have reflected across public data feeds. The fact that it was isolated to internal bank screens suggests a controlled, albeit briefly exposed, back-office operation. The Iraqi dinar has, for good reason, remained the centerpiece of these global revaluation discussions, and today's events have only deepened that focus. Iraq's narrative is one of immense potential, underpinned by vast oil reserves and an increasingly stable political landscape that is slowly pivoting toward modernization. Over the last year, the administration under Prime Minister Mohammed Shia al-Sudani has aggressively pursued a suite of financial reforms designed to integrate Iraq into the global economy. These reforms include strengthening anti-corruption frameworks, vastly expanding digital payment infrastructure to reduce the reliance on physical cash, and clamping down on the smuggling routes that have historically distorted the currency's value. These are not merely administrative changes. They are structural overhauls intended to create a monetary environment capable of supporting a stronger, internationally recognized currency. The timing of these digital flashes is particularly interesting when viewed against the backdrop of recent official statements from Baghdad. In May 2025, the Central Bank of Iraq issued a communication that resonated deeply within the international finance world, announcing that its preparatory work for establishing a unified, market-reflective exchange rate was nearly complete. For many seasoned observers, this statement was interpreted as a clear signal that the nation was positioning itself for a new era of economic engagement. The appearance of the Iraqi dinar on U.S. banking screens, flashing with adjusted values, seems to align with the technical implications of that announcement. It suggests that the preparatory work mentioned by the CBI may have moved from the planning phase into the active testing phase, where digital infrastructure is subjected to the pressures of real-world banking connectivity. Meanwhile, the Vietnamese dong's presence in this synchronized event adds another layer of complexity and validation to the theory of a broader global adjustment. Vietnam's economic story is vastly different from Iraq's, characterized not by post-conflict recovery but by decades of steady, impressive industrial rise, with a booming manufacturing sector, a rapidly expanding middle class, and deep trade ties with the United States and the European Union. Vietnam's economic fundamentals have long suggested that its currency is undervalued. The International Monetary Fund has frequently noted that the dong is kept at levels designed to support export competitiveness, but recent regulatory shifts suggest a change in strategy. Vietnam has recently implemented new frameworks to increase transparency, monitor capital flows, and enhance compliance with global banking standards, signaling a readiness for a more mature valuation. The simultaneous appearance of the Vietnamese dong alongside the Iraqi dinar in these bank system flashes has led analysts to consider the possibility of a coordinated multi-currency event, If these were isolated incidents, one might dismiss them as random errors, but the fact that two currencies often cited as candidates for revaluation appeared together suggests a structured testing protocol. This aligns with the concept of a global monetary recalibration, where multiple sovereign currencies are adjusted in tandem to reflect new economic realities. While this remains speculative, the technical evidence of the DACE, specifically the synchronized nature of the day to injection across different banking institutions, points toward an organized simulation designed to test the readiness of the global financial architecture for updated valuations. It is also crucial to address the currency that was notably absent from today's specific U.S. banking flashes, the Zimbabwean dollar or its gold-backed successor. While the ZWL did not appear in the American system tests today, it remains a critical element of the broader conversation regarding global currency reform. Zimbabwe has been undertaking ambitious steps toward monetary rehabilitation, introducing a gold-backed currency model in early 2025 to combat hyperinflation and restore confidence. Sources from East and Southern Africa have indicated improvements in regional interbank settlement rates, leading some analysts to believe that while Zimbabwe may not be in the exact same testing cycle as Iraq and Vietnam today, it is likely scheduled for integration in a subsequent phase. The absence of a flash for the ZWL does not diminish its potential. Rather, it highlights the phased nature of these massive global undertakings. Global financial institutions such as the IMF, the World Bank, and the U.S. Treasury operate on timelines that are notoriously slow and methodical. However, recent reports from these bodies have placed both Iraq and Vietnam in a favorable light, acknowledging their substantial progress in governance and monetary policy. The IMF June 2025 assessments explicitly praised the modernization efforts of both nations, and the U.S. Treasury's removal of currency manipulation concerns indicates a high level of trust and cooperation. These institutional stamps of approval are prerequisites for any major revaluation event. The Bank for International Settlements has also long confirmed that sovereign-level adjustments require extensive private buy-in testing before they are ever made visible to the public. Today's event appears to be a manifestation of exactly that kind of testing protocol. Returning to the specifics of the bank activity, the aftermath of the flashes offered further clues to the nature of the event. Following the appearance of the new rates, several banks reportedly restricted or temporarily suspended their foreign currency services, citing maintenance outages or system updates. While such messages are standard during technical difficulties, the timing, aligning perfectly with the digital flashes, added fuel to the speculation. In the world of high-stakes finance, maintenance is often a euphemism for the implementation of new system configurations. This response from the banks suggests that the flashes were not merely display errors, but were symptomatic of a larger data handling process that required a temporary shutdown of consumer-facing services to rectify or secure. The digital footprint of this event was massive. Data analytics firms reported a 300% spike in traffic to websites and forums associated with dinar and dong information immediately following the flashes. This overwhelming surge in interest demonstrates how closely the community is watching for signs of movement. Behind the scenes, off-record sources connected to systems analysis and former advisory roles have provided context that supports the testing hypothesis. These individuals have reportedly stated that synchronized digital flashes are characteristic of coordinated liquidity environment tests, structured procedures used to ensure that when a new rate is finally live, the system has the liquidity and the technical pathways to handle the volume of transactions that will ensue. One particular source, described as having deep knowledge of financial network operations, commented that when internal rates appear externally, Even for a brief second, it often indicates that the process is entering its final stages. This visibility leak usually happens when the barriers between the test environment and the live environment are momentarily lowered during a propagation cycle. Such events are often pending final political approval, compliance verification, and settlement preparation. This perspective shifts the narrative from a simple glitch to a sign of operational readiness, suggesting that the technical capability to handle the new rates is already being installed and verified within the banking architecture. Adding to the intrigue are the persistent rumors regarding high-net worth clients and wealth management firms. Stories have circulated suggesting that select individuals received subtle messages from their financial advisors, instructing them to remain available locally for the next 3 to 4 days. While anecdotal, this pattern has historically preceded major institutional events, serving as a quiet warning to those with significant assets to be ready for rapid decision-making. These advisories rarely contain explicit details about revaluations but instead focus on availability and communication, hinting that a window of opportunity or a significant systemic shift is approaching that requires immediate attention. For holders of the Iraqi dinar, Vietnamese dong, and Zimbabwean currency, today's events serve as a potent reminder of the necessity of preparation. Regardless of whether a revaluation happens tomorrow or further down the line, the logistical requirements for managing such an event remain the same. It is vital to gather and secure all documentation tied to currency purchases, ensuring that provenance is clear and undeniable. Monitoring official sources rather than relying solely on online rumors is critical for maintaining a grounded perspective. Holders should identify which banks possess foreign currency desks and familiarize themselves with those institutions' specific procedures for exchange and deposit, which can vary significantly. Moving beyond the immediate reaction, we must also consider the fictional or scenario-based context that often circulates among theorists to explain the mechanics of what we are witnessing. In these deeper narrative explorations, experts describe a world where shadow-tier networks and institutional gateways operate beneath the polished surface of retail banking. In this view, the flashes are not errors, but the heartbeat of a living system being calibrated. Analysts stationed in global coordination hubs monitor these signals, looking for propagation checks, rare procedures where sovereign rate adjustments are routed through international networks to test for distortion or data loss. In this context, the visibility leak is the system showing its hand, revealing the immense pressure building behind the scenes. In these detailed scenarios, the absence of the Zimbabwean dollar in the US test is explained by the existence of a multi-phase rollout. The theory posits that the global financial architecture is too complex to update all at once. Instead, currencies are integrated in waves or tiers. Iraq and Vietnam, having met certain compliance milestones and economic benchmarks, may be in the early mover wave, while Zimbabwe, with its complex gold-backed model, is slated for a subsequent integration phase. This structured approach ensures that the global settlement engines are not overloaded and that each currency's new value is stabilized before the next one is introduced. The narrative continues by describing the tension inside central banks during such events. One can imagine the atmosphere within the strategy wings of the Central Bank of Iraq or the State Bank of Vietnam as these tests unfold. Officials and advisors would be scrutinizing real-time threads, noting the geographic spread of the anomalies. The fact that the rates appeared in multiple U.S. banks simultaneously would confirm to them that the transition phase is active and that the technical bridges between their domestic economy and the Western financial world are being established. This level of coordination implies a sovereign rate reconciliation process where international bodies ensure that the new values will not disrupt the equilibrium of the global financial system. Furthermore, these scenarios often discuss the role of intelligence and security in monitoring the fallout from such leaks. When speculation reaches a fever pitch, as it has today, it creates a unique set of risks. Intelligence agencies and financial oversight bodies would be tracking the spikes in communication and assessing whether the premature visibility of the rates poses a threat to national economic stability. The fact that no drastic shutdowns occurred suggests that while the leak was unintended, the system remained within acceptable parameters of stability. It paints a picture of a controlled, albeit high-stakes, environment where every digital signal is weighed and measured. As we look toward the immediate future, the 72-hour window, mentioned in the wealth management rumors, becomes a focal point of attention. In the theoretical models of currency revaluation, this timeframe is often associated with the interbank confirmation cycle. This is the period where sovereign rate outputs are aligned, reserve data is cross-referenced, and settlement pathways are locked in. During this time, it is not uncommon for banks to operate in a posture of controlled readiness, restricting access to certain services while the final configurations are applied. The alignment of today's flashes with this theoretical window has led many to believe that we are witnessing the precursor to a significant announcement. It is essential to approach this information with a clear and rational mindset. Speculative modeling from financial consultancies may produce hypothetical ranges for future values of the IQD, VND, and ZWL. But these figures are projections, not guarantees. They depend entirely on the complex interplay of economic fundamentals, global regulatory cooperation, and political will. The excitement of the day must be tempered with the understanding that these processes are incredibly complex and subject to change. The fact that a test occurred does not automatically guarantee an immediate public release, but it does signal that the machinery of change is in motion. Ultimately, today's synchronized digital flashes serve as the most compelling evidence yet that the conversation around global currency reform is moving from the theoretical to the operational. Whether this event was a final pre-implementation test, an early-stage rollout, or a rare glimpse behind the curtain of global finance, it signals meaningful movement beneath the surface. The patterns observed, coordinated bank activity, visibility leaks of specific rates, and subsequent maintenance modes, are consistent with the historic precedents of major financial shifts. We will continue to cover these updates with the clarity, professionalism, and caution that this subject demands. We advise our community to remain vigilant, to keep their records in order, and to verify information through multiple sources. The landscape of global finance is shifting, and while the exact timing of the final outcome remains written in the future, the signs of preparation are becoming increasingly difficult to ignore. As always, we remind you that this content is for informational and educational purposes only, and does not constitute financial, legal, or investment advice. Stay tuned to the Dinar Daily for further analysis as this story develops.